Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. I hope you can all hear me okay. You can all see the screen. You should be looking now at the economic calendar on the OANDA Market Pulse website. For those of you who are listening, if someone can just let me know that everything is working perfectly, that'd be great. Thank you very much, Walter. And we'll just crack on. So it's been a few weeks since we've held one of these webinars. So in terms of what's updated since then, it's been quite, it's been mainly political events, I guess, that has been driving the markets. Thank you very much, Cliff and Stephen. We have seen plenty of economic data in this time. We have seen a few movements on a central bank perspective. I think there's only one more notable move to come this year, and that will come from the Federal Reserve, where a rate hike is expected to be announced. The Bank of England raised interest rates, of course, for the first time since the financial crisis recently, and they're unexpected to act now at least for another 12 months, I would think. The ECB has made its move in extending its QE program, albeit at a reduced pace. The Bank of Japan has set its stalls out for more for ongoing stimulus. The RBA and the RBNZ have made their position perfectly clear. The Bank of Canada, having raised interest rates twice in 2 months, looks to have taken its foot off the pedal as well. So that just leaves the Federal Reserve to push ahead with its third interest rate hike this year, which is something that I think we'll certainly see. As you can see on the economic calendar here, I've loaded up all the events that we have for our respective countries that we're going to look at from a charts perspective today. So as you can see here, there's plenty of data on the agenda. There's also plenty of a central bank speak. So you can see, for example, today we heard from Haruhiko Kuroda, the Bank of Japan governor. There's plenty of speakers to come throughout the week. There's probably some that isn't on the calendar at this moment in time, which will be updated as the week progresses. So Federal Reserve speakers, Bank of England, etc. So that's something which we should certainly keep an eye on. Actually, we may be in the blackout period now for the Federal Reserve, so we may not see that. The blackout period, for those who don't know, begins the second Sunday preceding the Fed meeting, and that's when central bank speakers aren't allowed to appear in public speaking about monetary policy, which is all people mostly want to hear from them. You may hear some regulatory speak, but that's about it. But you can see that we've got PMIs, we've got the RBA decision in the early hours of tomorrow morning. You can see more PMIs from the US there. You can see straight away from the fact that we've got the ADP number on Wednesday that it's jobs week in the US, which means Friday we'll have the US jobs report. You can see that we've got the GDP numbers from New Zealand on Wednesday, and also GDP from the Euro area and jobless claims from the US. So there's plenty of economic data. I'd say we've got a select number of the numbers that will typically have an impact, and I include things like the PMIs, the GDP numbers in this, less so things like the jobless claims. We've got some important trade data from China overnight on Friday, but the biggie really is the US jobs report on Friday. And that is something which we'll be keeping a very close eye on, given the fact that not only are we likely to see a rate hike this month, but also we need to get an idea of how the economy is performing ahead of next year as well. A lot is going to change over the next 12 months from a US perspective, including, of course, the number of the people who are going to be sitting on the Fed board. Already it's been announced that Jerome Powell will replace Janet Yellen, who will not finish her term. She'll finish her term as governor, but she won't finish her term on the board of the FOMC. There's William Dudley has already announced that he's going to retire from the middle of next year. So I think there's around 4 positions which still need to be filled by Donald Trump, who will certainly be putting his stamp on the central bank over the coming months, and that will determine where we're moving in terms of interest rate hikes. But the Fed currently anticipates 3 next year, and that doesn't include the impacts from tax reform, which is moving very smoothly. So this is one of the political stories, really, that is having an impact on the markets, that is going to be a key focus throughout December, really, between now and Christmas. This period can typically be a little bit quieter. However, there's a number of political events which I think should keep it interesting. One of which is the tax reform. We saw on Friday that the Senate passed the tax reform bill. by a very, very narrow margin. What this now means is that that politicians from the Senate and from the House can now take their respective tax reform bills, which are very different in places, and discuss ways to amalgamate them and come up with a plan which will satisfy both the House and the Senate. Once this happens, then they will have a vote in the House and the Senate again, and that can then be passed on to Trump to pass. That may come later on this year, it may come early next year, depending on how these talks go between the two parts of Congress. Of course, if the House decides to just simply adopt the Senate plan, then that could push things through a little bit quicker. But ultimately, we're looking at the stimulatory impacts of this. And while it's debatable who is going to benefit and what kind of impact it's going to have from a stimulus perspective, it's clear that there is going to be at least some impact. Now, what this could do from a market's perspective and why the markets are so focused on this bill in particular is because there's a clear impact on equities, because if you're lowering the corporate tax rate, that's going to have an impact on the bottom line. There's going to be a clear impact because the US is such a consumer-driven economy on how much better off the lower middle classes are, who have a higher propensity to spend any additional revenue as a result of these this tax reform. And that's therefore going to have an impact on the overall economy, on inflation, and therefore on monetary policy as well. So the question is, are we going to see that fourth rate hike next year, for example, rather than 3? Market's currently only pricing in between 1 and 2. So that means there's still potentially some way to go in terms of pricing from the markets, assuming the Fed moves as is expected. In terms of other political stories, the Brexit negotiations continue to go on. We're very close to the deadline now, whereby if we want to move on to phase 2 at the start of next year, which is talking about trade and transition, then we need to clear the first 3 hurdles which the EU laid out, one of which is the exit bill, which we seem to be very close on now. The other is citizens' rights, which again there seems to be very close on. And the final stumbling block, which became more prominent in the last couple of weeks, was the border between Northern Ireland and the Republic of Ireland. But the rhetoric which we're hearing already today seems to suggest progress has been made here as well. So you can see, and as we'll see from the charts in a minute, people are becoming more optimistic. They're moving towards the trade and transition part of the agreement and away from these early negotiations, which is a positive for all concerned, but it also removes some of the uncertainty facing the UK for the next year, because had we not moved on, then this throws into massive doubt whether there's enough time for a trade deal to be agreed within the current deadline, because of course if we don't see a deal agreed, then we will revert to WTO rules, and that is going to have significant negative implications, particularly for the UK, also the Eurozone and the rest of the EU, but particularly I would say the UK. So positive developments here, but we are going to see a lot of emphasis on those negotiations, I would expect, over the next week or two, and I think that's going to have significant implications for the pound, and therefore the FTSE, for those of you who trade the UK 100, because of the negative correlation, the negative relationship between the two. And again, for those who are unaware, the reason for this is because I believe around 85% of profits generated by FTSE 100 companies are generated abroad. So when you have a weaker pound, then that's beneficial for these companies. If you generate your profits, for example, in dollars and convert them back, then that exchange rate when the pound is weaker boosts your sterling reported income. And that's why we've seen this negative relationship appear quite clearly, in particular since that Brexit referendum. So I think that covers everything from an economic and a political standpoint over the course of this week. There are other stories which you will see in the markets which are unrelated to this video. So to hear more, for example, about oil, then check out Jeff's video. I think he'll be releasing that tomorrow, his commodities update, where you'll hear, I'm sure, about the latest OPEC deal, OPEC and non-OPEC. There's 24 countries in total, 14 OPEC and Russia plus 9 outside of OPEC, where they've agreed to extend the output cut till the end of 2018, which is a slight positive for oil because it includes Libya and Nigeria, I think. And then the other story is, of course, Bitcoin, which you can read about in the post which we put up daily. I've been talking about that a little bit recently just because of the sheer volatility in Brexit, in Bitcoin. And I'm sure that's something that you're going to see a lot more in the headlines over the next couple of months if this remains. So if you want to read more about Bitcoin, then check out my pieces, which I put out every morning. But apart from that, let's move on to the charts, and we'll see how they have progressed or not progressed in some cases since the last video. Now you can see in euro dollar here that we have been making strides. Now I was keeping a close eye on the 1561.8 fib because this struck me as being a very important zone of potential resistance, and we did run into resistance here initially, and you can see that previously it's been support on a couple of occasions, and then on the way back up it was resistance. So this struck me as an important level, especially if we were going to see that stronger dollar into the end of the year, early next, and if we were going to see the euro pull back further after the decision by the ECB to extend its QE program to September next year at half the rate it was traveling. Now we did see a substantial pullback, of course, from around 121 back to around 115.50. I was curious as to whether we could see more, and there's still part of me that thinks we can and will. But it is a little bit disheartening that we've broken above this 1561.8 fib. For one, because it means we've made a new higher high, but two, it would suggest to me that what's going to be driving this move is going to be more dollar related than euro, because the euro is performing relatively well, not just against the dollar but up against other currencies as well. So clearly people are looking at what the ECB are doing and said this potentially is enough of a correction to warrant more buying. So people buying the dip, seeing this as an attractive level to buy the euro again. They're looking at the data, the PMIs, they're looking at the GDP figures, the unemployment numbers, etc. And they are effectively looking at this and saying the euro economy is gathering momentum, which of course it is, and this may mean tighter monetary policy down the road, which is what's continuing to support the euro. The opposing story here, which could drive some broader losses, is the dollar, because like I said, I think rate hikes next year are underpriced still, and I think that's certainly the case. I think if tax reform gets through, that's going to be a boost for the US dollar as well. So we'll see how this materializes. Of course, should we see a breakthrough 124, then this head and shoulders that we've talked about previously, which is far from complete, becomes null and void, and this becomes a failed charting pattern, and then we'll have to start looking beyond that. But at the moment, I'm a little bit disheartened by the break of the 61.8 fib and 50 fib combo, but as long as the previous high remains intact, then this head and shoulders very much remains in play. The only difference being how aggressive the move is going to be, because we're not seeing the same thing that we were seeing from 121 through 115.50, which was a stronger dollar and a weaker euro. It seems that we're seeing a battle of two potentially stronger currencies here, so it may just take a lot longer to materialize. In terms of cable, we have seen a strong resurgence in the pound, so this is something I was referring to when we were talking about the Brexit negotiations. We had a clear range that we were trading between, around 130 to 133.50. We finally broke above here last week on reports the Brexit negotiations were making progress, particularly on the bill. The figures that we were talking about prior to this was between 20 and 40 billion, depending on the transition deal. It seems now that the final figure that the UK is willing to accept supposedly is between 45 and 55 billion euros. Of course, there's no specifics because they're still going through the details. There's certain commitments which the UK looks to be proposing to the EU, with negotiations continuing amongst some of the more contentious, debatable points. And if that is enough to satisfy the EU, which signs suggest it is, then that would be positive for the pound, because it means another step forward, and that's what the pound has really rallied on. Now, be careful here, because should the EU reject what the UK has proposed across all three fronts and say that not enough progress has been made, which means puts us in the delay till next year, I'd expect to see these gains reversed quite quickly and see us trading back in this range, if not after over the coming weeks towards the lower end of the range. Should we move on to phase two, then that could provide another boost for the pound. Again, it just removes one more hurdle. But the next area of resistance does clearly lie around these 136, 136.50s. Whether we can overcome that is yet to be seen. I remain skeptical to an extent, just because I still think there's a long way to go, and I don't foresee any rate hikes over the next 12 months. But should we go through those 136.50s, then you can't ignore it, at which point you're looking back towards these kind of 138s to 138.50s as prior support for potential resistance. But to the downside, you're looking at the moment around 133, 133.50, which was that prior resistance zone, which, should we see that tested, could offer some support. Euro sterling remains range bound, although momentum looks to be gathering slightly with the pound. We've seen a very bearish day today, for example. Now, what's interesting here is you've got this clear support. This clear support around the 87.75 through 87.50 level. Now, this has been a notable level support since June. We've seen it tested over and over and over again. The 200 and 233-day simple moving average band has offered support on the most recent attempt as well. But now that we're seeing this come under pressure, should we see that break, we're not just seeing a break of long-term support, we're seeing a break of two key moving averages as well. So that would be quite a bearish signal for me. And if we see that happen, then initial support comes in around these kind of 86.50s. But I think a break of this would trigger a more sizable move to the downside. Below 86.50, you could be looking at these kind of 85.25s. And again, if we zoom out to get a clearer picture of where we're at, so you can see, like I say, these 85.25s potentially finding some resistance. I would say around these kind of 85.75s as well. You can see there's points through here where that has been support and resistance. But ultimately, I think a breakthrough there, and we're looking back towards this kind of range in the medium to long term. So we're looking back more towards the kind of 83s through 84s. Big support over the course of the last year or so, basically since the Brexit referendum itself, and that would be quite a hurdle. That would be quite a significant move as well, particularly given, as I say, people seem to be holding on to their bullish euro views as seen in the euro dollar pair. Australian dollar versus the US dollar, we have run into a little bit of support, but we can see this still looks bearish to me, and there's a couple of reasons why. One, we came back off this downtrend. We had a little correction. We ran into resistance immediately around the 38.2 prior resistance. 38.2 bounce and continuation always strikes me as being particularly bearish, because it suggests that people are not interested in waiting for these higher corrections. They're already interested in selling straight away at the first technical opportunity, and that's always a bearish signal to me. Off that, we have made new lows. We've come back into this larger support zone, which I will zoom out and show you now, which is these previous lows. We had already broken below the moving averages, which I've highlighted in a previous video. And now we're seeing a little bit of consolidation again, similar to kind of what we saw here. Maybe we are going to see a bit more of a correction, at which point we'll be looking at probably the broader move. So rather using the most recent lows, if we're going to see a broader correction, then I want to see the full move. So again, this brings this kind of 77.50, 77.60 zone into view, but it could be more than that. In terms of momentum, if we're looking at these indicators at the bottom, we have some lower lows being made, but you look at the MACD histogram, for example, we're seeing higher lows being made here. We're seeing a flattening in the MACD moving averages as well. And you look at the stochastic, two relatively high lows. We've come close to making a little low in price here, whereas the stochastic is a significantly higher level. So in terms of key levels here, I would be interested in looking initially at around these kinds of levels, because we're talking about prior support and resistance. So a break of that could be potentially a bullish signal. Given the fact that we've had this consolidation following a little higher low, I think we're only looking at prospective levels here because we've only got two touches on these things. But we could be looking at a rising wedge, which means that we make a higher high, but at the same time, rising wedges and downtrend is a bearish signal. The momentum figures would suggest to me that what we're actually looking at here more is a rising triangle, which is a bullish signal and gives us a potential scope for a move back towards this kind of 38.2 fib levels. If we see a break below this rising trend line, I'd like to see one more touch first to confirm it, because 2 touches is potential trend line, 3 touches is confirmed. But a break below this trend line may suggest to me that there's more downside to come, but I would like confirmation as well from those momentum indicators, the MACD and the stochastic at the bottom. But at the moment, it looks like a bit of a consolidation phase to me, and that, when you've got a trend like this previously, would suggest that momentum is still with the downtrend. But again, a break through these 76.50s, potentially triggering a bit of a correction. Longer term, I remain bearish, but that doesn't mean we can't see corrections along the way. Dollar CAD, we've seen it consolidate as well since the end of October. We can see a clear high here around the 50 fib, which comes in around the 129s. You can see clear support here around 126.50. This looks like a kind of double top formation in the broader following this brief uptrend, but that brief uptrend, as I've stated previously, was part of a broader downtrend. Should we see a break of this support, then that would be quite a bearish signal for me, just simply because we've got a double top in a rising uptrend, which is part of a longer term downtrend off a fib. So that'd be a nice bearish signal for me. The good thing about double tops is that it gives you potential price target levels. So when you're looking at 126.60 more like, and you've got a high of around 129.10, that's quite a sizable possible potential price projection of around 250 pips. So this gives you a potential price projection back to around the kind of 124 levels, 124.10s, which actually brings you back to these previous lows. You can see we've got a support zone from previously here, so that's where I'd be very interested in. Should we see a break of that double top formation? Of course, nothing's guaranteed. We wait for confirmation on everything. This is just merely a case of highlighting possible key levels, but a breaker here, and then this would be the area of the noteworthy area for me. I'd be encouraged by the 50 fib rejection, and a break of this, then we'd be looking back at the lows. But I'm encouraged by the 50 fib rejection, but I'm waiting confirmation via a break of this support. And of course, you look at Friday's move, and that is very encouraging indeed. Again, sterling CAD, we saw this big red candle on Friday, very, very bearish signal indeed. This came around prior support and resistance levels, which you can zoom out and show you here. You can see that this has been a noteworthy area of resistance for quite some time. We broke above here briefly at one point. Should we see a breakthrough this resistance zone again, then I would be keeping a very close eye on those previous highs. But for now, it looks as though momentum has just turned significantly in favor of the bears. This is a very big Marubozu candle. We haven't even paired those losses very much at all. You can sometimes see a move back towards the 50% of around 50% of the Marubozu candle. That's known as the Marubozu line, and that is a noteworthy area of resistance following the formation of a Marubozu candle. We haven't even got close to that far at this stage. In reality, I'm looking at this falling trend line for a potential bearish signal. Probably looking at a couple of them because it's a little bit imperfect, but I can't ignore the line underneath as well. So kind of rising trend line zone as opposed to an individual trend line. But let's face it, that's no different than what I do when I'm looking at support and resistance zones rather than support and resistance levels. But like I say, this is still looking quite bearish. Not only Friday's Marubozu candle, but the what's known as a dead cat bounce that we're seeing today is potentially a bearish signal here as well. Now, the pound is going to provide some counter strength for this pair, especially if we do see a Brexit deal materialise. But at the moment, purely reading the charts and ignoring the fundamentals, we're not seeing any signs of that getting any major upside compared to what the moves that we've seen in the Canadian dollar. Kiwi dollar, US dollar next. Momentum, again, we have seen this big move to the downside. We saw it make a new low here. This came after that rising channel, which was a bearish signal. We did see it make a new low here, but you look at the momentum indicators and there was really nothing to support it. Rising lows on the stochastic, rising lows on the MACD histogram, rising lows on the MACD moving averages. And we followed that by making a higher low at this moment in time. Now, we could still make lower lows, of course, but it's not a bullish engulfing pattern per se, because we've still got a little bit of an upper wick and a lower wick. But the message, I don't think, is too dramatically different. I think what we're effectively seeing is a trend which has been significantly to the downside, and there is potential at this moment in time for a bit of a correction. I wonder if we've effectively got a bit of a falling channel here, because those can be sometimes be pretty good indicators. Let me try that one again. Because when you see in a downtrend and you see the trend effectively weakening, which is what we've seen here, because you've seen aggressive moves low, you've seen a wet trend weakening, so we're still seeing lower highs and lower lows, but we're seeing it at a much in a much smaller way than what we were seeing previously. Then this is, especially when it's being accompanied by much less momentum as it is in this case, then that can sometimes be a bullish signal. And the fact that we've seen such a strong downtrend would suggest that to me as well. I think the initial signal here comes from a break of this falling channel. So if we see a breakthrough there, then you've got to get confirmation. So confirmation comes from making new highs, breaking previous highs, and then you're looking back towards this zone once again. The initial confirmation, though, the initial signal, in my view here, comes from a break of this falling channel, but the signs are all there. No momentum, a lower low, but only briefly, and a higher low, which looks to have formed since then. So potentially some bullish red flags appearing in Kiwi dollar, US dollar right now. As always, we'll wrap things up with the yen pairs. Dollar yen, it's little change. I was becoming quite optimistic that we may see a breakthrough the top of dollar yen. I feel like it's been a long time coming. I feel like it's overdue. I feel like we're in a far more bullish risk environment, and I thought that may have helped it and hindered the yen. Tax reform progress I thought may have helped it as well, and we may see that materializing right now. But we're still trading in this sideways trend, which we have traded in for most of the year. We've come back to 111 and we've run into support once again. 111 has been a key level throughout this period, but we've also got the bottom of the Ichimoku cloud here also. We've got possible resistance forming around the 113s, which was previous support and resistance. So we could see a pullback to the downside here, a breakthrough here, and I think we're looking back at the top of the sideways channel. But really, this is just long-term, wide-ranging, choppy market still. And until we see a break of these 114.50s, there's no reason to believe that that's gonna change. We didn't even get a new higher low forming here to suggest that this has changed away from the choppiness which we were seeing previously. So break of this 113 could signal a move back towards the 114.50s, but as of yet, I'm seeing little reason to be overly bullish on this particular pair. Sterling yen, on the other hand, is trading back towards the top of its range again, for obvious reasons. I think we've got two levels which we need to keep an eye out for here. Well, two main levels and a third area. So you've got the previous highs. I think we're seeing resistance now around the kind of 115, 152.90s, 153s as we did previously. But this is still bullish. We've got three bullish candles here, and especially the third one. We saw a bit of a correction, but it wasn't a significant rejection. And already today we are seeing this rally again. So this is looking like a weak resistance level for me right now, and I really wouldn't be surprised to see this break, at which point the 153.60s become a notable level of resistance for me. And beyond there, we're looking back a fair while. But a break of this could be potentially quite significant, looking back towards the kind of 160s in the longer term. Of course, there's still some way to go, but I mean, the problem that we've now got is we're looking back at pre-Brexit levels for support and resistance. So you could be looking at kind of areas like this kind of 156, which you can see was resistance here, support here as well as the next possible important level. So a break through these kind of 153.50s is quite significant as far as I'm concerned. But it looks as though momentum is very much building with the bulls here, as you can see by recent price action, and momentum is very much backing that up. Should we see a move to the downside, then you've got the important support level, which comes around 147, prior support on two occasions. That's not a coincidence. It's also the bottom of the Ichimoku cloud, so that a break of that would be a very bearish signal indeed. We've also got a congestion zone, which I'm continuing to highlight, because you could see that throughout this period here and here, price approached this congestion zone, and what may have broken below it previously, this is where the momentum really started to fall out the move. So this could be a good signal heading into the 147s should that materialize. But again, this is looking quite bullish in the near term for me. Finally, euro yen hasn't changed, so there's nothing to really update here. We continue to trade in this sideways pattern. Looked as though we had a double top forming here. We had a lower low or a lower low here that may have been a kind of triangle forming bearish momentum building to the downside, but then we made a new higher high. Sorry, that was a lower high, then we made a new higher high here. However, should we stay below the 134.50s, then all we're really seeing here is a potential triple top forming, and again, a break at this level would then be very bearish. Alternatively, if we see a break through those highs, then this consolidation would have been exhausted, and that would be, again, once again, a bullish signal and could potentially trigger a more significant move to the downside. You'll see that my moving averages here are shortened. If you see that on your charts as well, you just need to zoom out on the charts, and once it gathers more data as it does when you do zoom out, then the moving averages can be recalculated and will move out as well. Should we see a breakthrough those highs, then again it would be a bullish signal, and I think 137s is the next notable area of resistance. You could see some resistance forming along the way, say around these using these previous highs, areas of resistance and support here, so around 136.25, and there's a nice one I think around here around 135.25, but ultimately a break of that resistance, and I think we're headed back towards these kind of 137s, 137.50s, and that would be the next major area of resistance. But we'll have to wait and see how that pans out, because for me we haven't seen a big enough correction in this yet, and I think corrections are always healthy for the markets, and unlike the pound and against the yen, I'm not seeing as much upward momentum forming in this pair as I was seeing in the others. But again, should we see a breakout, then that's all that matters. Well, that's all we've got time for today. I hope you all found that useful. I haven't seen any questions come through, so rather than drag this on, I will wrap it up. Thank you very much for joining as always. I hope you all have a fantastic trading week. I wish you all the best of luck with your trading, and I hope you join me again soon for another one of these webinars. Thank you very much.